Hello, welcome to my NMLS Safe Test calculation video. I'm NMLS Safe Instructor Andrew Larson. In addition to having experience in both mortgages and real estate, I passed the Safe Test the first time with 85%. In this video, I'll try to help you do the same. The Safe Test is hard. Most people fail it the first time. When you fail, you have to wait 30 days before you can take it again. After the third fail, you have to wait 6 months. If you think you know the material pretty well, and you think you'll go give the test a try, you'll fail. With sufficient preparation, the Safe Test is passable the first time. You'll need to know the material cold. The Safe Test has 125 questions. 115 questions are graded, and 10 questions are sample questions distributed throughout the 5 sections. The questions are multiple choice. There's a lot of trick questions and questions with more information that you need in order to answer the question. You need 75% of your answers correct to pass the test. There's plenty of time to take the test. Rarely does someone fail because they run out of time. You're not allowed to bring anything with you when you take the test. All of your belongings that you arrive with will be required to be locked in a locker. They will provide you with a calculator, scratch paper, and a pen or a pencil. Okay, let's dive into the calculations. Let's start with 15-year versus 30-year loans. On the test, they may ask you if interest rates on 15-year loans tend to be higher or lower than that of 30-year loans. They tend to be 0.25% to 1% lower. Let's compare the two loans. Okay, let's start with the 30-year loan. A $300,000 loan over 30 years at 4.5% interest is $1,520.06 per month principal and interest. Total interest over the term of the loan, $247,220.13. Now let's look at the 15-year loan. $300,000 over 15 years at a 3.5% interest rate, monthly payments of $2,144.65 per month, which isn't a whole lot more than that of the 30-year loan. Interest is $86,036.57 over the course of the loan, with a savings of $161,183.56. The savings on the 15-year loan is more than half the principal of the house. Okay, let's talk about LTV and CLTV. LTV is short for loan to value. CLTV is short for combined loan to value. Loan to value is the percentage of the value of the property that one loan is financing. Combined loan to value is the percentage of the value of the property that the aggregate of all of the loans is financing. In this loan to value example, we have a home with a value of $100,000 and a $15,000 down payment. This leaves us with a loan to value of 85%. The higher the loan to value, the higher the risk to the lender. Higher risk means higher interest rates and/or higher likelihood of the requirement of mortgage insurance, which subsequently increases cost to the borrower. Here, in our combined loan to value example, we have a house with a value of $100,000 and a down payment of $10,000. The combination of the two loans of the property adds up to $90,000, which is 90% of the $100,000 value of the property. This leaves us with a combined loan to value of 90%. Okay, let's talk about mortgage insurance. This is an additional premium that the borrower pays, so the lender will provide the borrower financing that they otherwise wouldn't provide at the low down payment or no down payment that the borrower is receiving in a given loan program. This is because low down payment increases risk to the lender. PMI and MIP are forms of mortgage insurance. PMI is short for private mortgage insurance. PMI is for conventional loans. MIP is short for mortgage insurance premium. MIP is for FHA loans. Conventional loans require private mortgage insurance when the borrower pays less than 20% down. FHA loans always require mortgage insurance premium. Private mortgage insurance has automatic cancellation. A condition of this is that the borrower is current with their periodical payments. For purposes of this, the value of the property that is used is the value at which it was calculated at the time that the loan was originally taken out. The PMI cancels when the loan is paid to a point of 22% equity or 78% LTV. MIP also has automatic cancellation. On FHA loans made after June 13, 2013, however, this only applies if the borrower paid a 10% down payment at the beginning of the loan. Under those circumstances, automatic cancellation takes place after 11 years. Both PMI and MIP mortgage insurance has both upfront premiums and premiums that are renewable. Here's a sample PMI calculation. We'll calculate the monthly payment increase due to PMI, where the coverage rate is 0.59% with a 90% LTV on a $110,000 home. First, we calculate the amount of the loan. With a 90% LTV, 90% of $110,000 is $99,000. Then we multiply the loan amount by the 0.59% coverage rate, which is $584.10. Then we divide that by 12 months. This calculates to a monthly mortgage insurance premium of $48.68. Okay, let's talk about ATR. ATR is short for ability to repay. These days, good credit and sufficient collateral isn't enough. For regulators to ensure that predatory lending practices aren't taking place, the borrower's ability to repay the loan is also an important factor. ATR is calculated by ratios. For purposes of this video, we're not going to calculate in compensating factors which can change ratio requirements. There's two ratios that are used: housing expense ratio, which is also referred to as front-end ratio, and debt-to-income ratio, which is also referred to as total debt-to-income ratio, DTI, and back-end ratio. For both ratios, the first thing you'll need to calculate is the borrower's income. Remember, there's not exactly 4 weeks in a month. That will be their weekly income times 52 weeks divided by 12 months. This will calculate their monthly income, which is the income that you need for ATR aspect of qualification. Once you've calculated the borrower's income, it's time to calculate their housing expense ratio monthly payment. Simply take their income and multiply it by 28% for a conventional loan or 31% for an FHA loan. This will calculate the monthly payment for which the borrower qualifies under the front-end ratio calculation. To calculate the DTI, take the borrower's income again, multiply that by 36% for a conventional loan, 43% for an FHA loan, or 41% for a VA loan. Then subtract their monthly debt obligations such as car, credit card payment, etc. That will give you the monthly payment for which the borrower will qualify under the back-end ratio calculation. The borrower will qualify for the monthly payment which is the lowest between the front-end and the back-end ratio calculations. This is because the borrower must qualify under both ratio calculations. VA loans is the exception, as VA loans tend to use only the back-end ratio. Okay, let's talk about VA entitlement pertinent to VA loans. As of the year 2020, a borrower with VA loan eligibility and their full entitlement, they have no limit as to the size of the VA loan they can get as long as the lender will lend on it. Unlike FHA loans, VA loans has what's referred to as partial entitlement. This takes place when a borrower still has a VA loan that isn't paid off yet and now they want to get another one. To calculate the partial VA entitlement of a VA borrower, first, calculate 25% of the maximum loan amount in a conforming conventional loan program in the county that they want to buy their next home. Then subtract from that 25% of the original loan amount of the VA loan that's not paid off. This equals the amount of VA guarantee entitlement that's available to that borrower. Now multiply the VA borrower's guarantee entitlement by 4 to calculate the value of home they can acquire with no money down. If the VA borrower wants a home with a higher value, the difference between the two amounts is their down payment if the borrower still wants to select that loan program. When the purchase price is more than the appraisal value, the buyer's down payment is what it normally would be, plus the difference between the appraisal value and the purchase price. USDA loans are also known as rural loans and Section 502 loans. Like VA loans, these are also no money down loans. With USDA loans, the borrower doesn't have to have any affiliation with the military to get them. This is the only loan program that has a maximum limit on borrower income. The income limit is 115% of the area median income. There are also a number of other borrower and property requirements that are unique to these loans. PITI refers to the borrower's monthly payment. This payment includes principal, interest, taxes, and homeowner's insurance. It also includes homeowners association dues if applicable, and flood insurance if the property is in an A or V flood zone. An A or a V flood zone means that the property has at least a 1% chance of getting flooded in any given year. Minimum down payments conditional on sufficient credit include the following. A borrower with a middle FICO score of 580 or above has a down payment of 3.5% on an FHA loan. A borrower with a credit of 500 to 579 on an FHA loan is at 10% down, and a borrower with a middle FICO score below 500 is ineligible for the FHA loan program. Conventional loan programs are as low as 3% down, and VA and USDA loans are no money down. Okay, let's talk about adjustable rate mortgages, also known as ARMs or hybrid ARMs. Hybrid ARM simply means the interest rate stays the same for multiple years before it starts adjusting. Notice I didn't say the word fixed on the topic of ARMs, and you shouldn't either. In adjustable rate mortgages, the borrower always pays the lowest of three calculations: the max lifetime rate, the adjustment rate cap, and the fully indexed rate. Interest rate caps are indicated as 2 or 3 numbers. The number on the far right in both cases is the highest amount the interest rate can increase over the term of the entire loan. In both cases, the number just to the left of that is the most the interest rate can increase at each adjustment. In a 3-number cap, the number on the far left is the most the interest rate can increase only at the first adjustment. The fully indexed rate is calculated as the margin plus the selected index for that loan at that point in the loan. The max lifetime interest rate equals the start rate plus the last number in the loan cap. The adjustment cap equals the previous rate plus the adjustment cap indicated just to the left of the lifetime cap. In the event of a 3-number cap, when it's the first adjustment, the previous rate will be added to the cap number on the far left. Thank you for spending your time with my NMLS Safe Test Calculations video. I hope it was helpful. I encourage you to proliferate the link to this video to everyone you know that this can help. I know YouTube videos are constantly asking you to like and subscribe. I can tell you that if you do this for me, it really helps a lot. Best wishes on the safe test. See you in the mortgage business.